I'm Rok. I spent the last 20 years of my life in e-commerce. I built two e-commerce businesses to 50 million per year, and I mostly deal in e-commerce startups. Sitting next to me is Val Kuznetcov, who has really impressed me above and beyond with his incredible economic and financial LinkedIn posts over the past few months. And from what I've seen, he's truly amazing at helping companies improve their growth and bottom line. So, Val, would you care to do a short intro of yourself?
Yes, Rok, thank you so much for having me on this little interview. Really honored to be here. I've been in e-commerce for about 5 years. Just recently really got into the LinkedIn game and wanted to share some of the knowledge accumulated over the past 5 years. One of the reasons why that pushed me to do so and get into the e-commerce space and D2C space is because I saw a huge gap in finance, marketing, and operations. It seemed like everything was run in isolation, right? Lots of marketing agencies focusing on marketing, some operational people and financial people focusing on finance and operations, but no one doing everything holistically, in combination. And I really, I recognize that there is an opportunity to fill this gap and help brands build a more holistic approach to e-commerce. And that's where we stand right now. It's been quite a journey, and I'm excited for what's to come.
So, well, from what I understand, you help more than 25 companies improve their bottom line. What are usually the quick, easy financial, operational fixes that e-com businesses can do to make at least a sort of quick turnaround?
Yeah, that's an interesting question. There is no one template that works for everyone, but I would recommend taking a look at your operating expenses first, because this is the most overlooked aspect of your business, right? Most of the time people focus on gross margins, on average order value and stuff like this, and those usually help you get to a much better profit position, profitability and cash flow position. But operating expenses is the expenses that kill your business. For instance, if you're spending, $10,000 on content creation every month, right, and your gross profit margin is 50%, that means that you need $20,000 in revenue every month just to recoup the investment on your content, right? So taking a look at your operating expenses, listing them from largest to smallest, and understanding what is the net benefit or net loss of each dollar spent in that category, right? And then identifying the potential cutbacks or, the reductions in those costs, and trying to get to a much more stable and solid profitability position, because as you know, fixed costs, they don't look at your revenue, right? They repeat themselves, they're recurring, they're going to carry over month, and that's why you want to keep them as little as possible.
So you're not saying essentially, just cut your workforce in half and you're done.
Of course not.
So when you start working with a company, what would be your process to figure out what the problems are, where the opportunities are? If you could maybe take us step by step, through the most important things that you would look at if you start working with a company, today.
Sure, yeah. Usually the framework is pretty simple, right? I take a look at the financials, P&L, balance sheet, cash flow statement. I have, a certain model that I use for my clients that I paste their numbers into, and then it tells me what the financial ratios are and what the supposed benchmarks should be for this business, right? So let's say if your inventory, is too much for what it should be, right? Then I will note that, and I will know that I should dig in deeper to see if there is a lot of overstock or if there is a lot of product overdose. That's what I call it, right? There's too many products and you're not turning them fast enough, and that's why you're carrying this huge balance on your balance sheet, and that's showing through the financial ratios. Then, of course, beyond that, I take a look at the typical e-commerce metrics and financial models like CAC to LTV, models unit economics, and we dive in deeper to see if there's an opportunity to squeeze more margin from your products, from your customers, and then applying that to the financial statements to see if there's a gap between those and how we can bridge that gap.
And how, for example, do you deduct that a company has too much stock? Where do you get the benchmarks from somewhere? Is it by type of business, by category, by industry? How do you actually figure that out?
Yeah, I usually look at the turnover, right? And then compare it to sales. So let's say, if you're carrying 6 months of inventory and your lead time is 3 months, the potential overstock is 3 months, right? Because you could actually get product within 3 months. You don't need the other 3 months. And even if you add the safety margin, that could be too much. So why exactly are you carrying that much? Then I break down the overstock by category of products. So let's say if you're a fashion brand and you have pants, you have shirts, right? I look at each category separately and identify, okay, so pants are selling much better for your brand. This is your hero product, your core product line. Why are you carrying so many t-shirts, right? Which is the reason for your overstock. You might want to reduce the amount of stock that you carry, maybe renegotiate your terms with suppliers, see if you can change the MOQs, change the lead time. Maybe they can produce it in a much shorter period of time. So maybe, send out partial shipments. Let's say the total production lead time is 3 months, but you might sacrifice some of the margin to improve the cash flow to get the products into 2 shipments rather than 1 shipment and ship, half of the batch in 1 month, 2 months, and then the rest in the next 2 months, right? So understanding what kind of sales you have, what kind of profit margins you have, and profit contributions by category, by product, and then seeing in comparison if you carry too much of it, and then trying to dial in and cut the products that are not really contributing much.
So, by the way, before we move to dig a bit deeper into this, okay, this is all essentially running a business in finance, almost 101. Why do you think that so few e-commerce companies, especially those making, up to 20, 30 million, 40 million, actually do this in their daily lives? What's the root cause for companies just not doing this?
Yeah, I think it has to do with a lot of finance and operations people themselves. I think they are bad at selling ideas, right? And marketing people are great at selling. That's what they do, right? Every day. So when you hear someone say, look, we can boost your profit margin by 20%, or we can increase your AOV, of course you're going to buy into that because you know that it matters to you. But when finance person says, well, you should run a P&L and pinpoint some of the areas for improvement. Okay, how does that translate into outcomes, right? What do I get from it? Is it more profit? Is it more cash? How do I know that this is important for me? And a lot of finance people do a very poor job, especially in e-commerce space. And most of them, quite frankly, don't have that understanding of e-commerce holistically, right? They just say, P&L, cash flow statements, and that's where it ends. But it's the translation and how finance overlaps with marketing and operations that makes it so beautiful in e-commerce.
Yeah, perfect. Because personally, I'm a freak on e-commerce economics. I'm a freak on P&Ls. I've built systems where we were running 60 different P&Ls plus different central support function P&Ls, cash flow, all of that. But then, when speaking with the financial people, like the CFO, usually, they come mainly with let's cut cost ideas and not really with enough of an understanding of how the e-commerce business works. And of course, you have your doubts, right? You push back. I often push back on my finance people just because, we still want growth. And sometimes you have to, sometimes you just have to shut down your eyes, increase your speed, and hope that you get through the bumps alive.
True. That's true. Yeah, that's what goes sometimes in life. You just got to understand the trade-offs, right? Maybe this is a stage at which you grow, you sacrifice some of the profitability, you get more people aboard, and then you get to the optimization stage, and that's when you start focusing more on profitability rather than growth. So it's always a trade-off, right?
So the solution definitely always marketing people are getting a better understanding of economics and finance, and financial people getting a better understanding of marketing, e-commerce, and sales. Yeah, that would be a nice combination in real life. So before you mentioned a lot, product overstocks, managing your inventory. So in your mind, what's the real cost of product overstocks? And how do you manage the danger of losing money on selling out overstocks and high discounts? Because that can often mean lower gross margins, and then with cost of customer acquisition on top of that. How do you balance all of this?
Yeah, well, let's take a look at it, right? There's 2 scenarios. One is you have too much stock, and the other one is you don't have enough stock, right? Out of stock situation. I would argue that the out of stock situation is not really a big deal as long as you're restocking soon enough, right? Because if you take much longer to restock, then you might lose some of the interest of the newly acquired customers, right? And some of the older customers as well will lose interest, so you have to re-engage again. And unless you have a very strong brand, that's going to be more challenging and more costly, right?
Yeah, and don't forget losing your Google positions and your Amazon positions.
Absolutely, yeah. I mean, if you bid on keywords and etc., that's going to lose you a ton of money. But if you're, if you do it the right way, you might not experience too much of an out of stock challenges, right? Now, when it comes to overstock, I find that to be a much more dangerous situation, right? If you carry dead stock, especially, that's going to be hard to blow out or get rid of, right? And again, we have this tendency to hold on to things, right? And sometimes you just got to let go, right? And it's a very challenging, idea for you to cut products. What if we lose revenue? But sometimes cutting products saves you, right? And that means dealing with overstock. Now, going back to your question, what is the real cost of overstock? Well, if you think about it, there is a couple of things, right? One is the opportunity cost, right? So you have this overstock, let's say $200,000 in inventory that hasn't sold for 90 days, right? And who knows when it's going to sell. That $200,000, right? If your customer acquisition cost is $100, right, or $50, that's 2,000 customers or 4,000 customers that you could have gotten if you didn't have that overstock on your balance sheet. So think about that. Think about the implications, right? If your average order value is $100, that's $200,000 or $400,000 in revenue, right? For you to just carry that dead stock that you don't want to let go of, you're sacrificing the profitability and more revenue from new customers that you could have acquired, right? So that's number one. And opportunity cost is the biggest one. The second one is the cost of capital, right? I mean, we don't think about that, especially when we're bootstrapped, but everything that you spend money on also has an internal rate of return, right? There's an IRR formula or analysis that you should do, right? Even if you didn't borrow money, there is a special or expected rate of return for your business. Let's say it's 15% because that's your net profit margin, right? So you want to expect any dollar invested in anything to bring back 15%. And if overstock is on your balance sheet for a long time, that means that dollar is not bringing you 15%. And that accumulates because of compounding effect. Every month, you just accumulate the loss of not returning money. And that's your opportunity cost. Or not the opportunity cost, but the rate of return, right? The cost of capital. And of course, money loses value over time. So that's all, packaged up nicely. It's not as high as the opportunity cost, but high enough as well to consider. And I would also argue that the carrying overstock, something that is not really quantitative, you can't really capture it, but the qualitative aspect of it, right? It's the stress. It's the the fact that your team doesn't know what to focus on, that spreads their focus. So they think about how to get rid of overstock instead of focusing on driving more revenue. So the productivity drops, right? And it's hard to capture what exactly that is. But when productivity drops, we know how hard it is to keep the morale up, to keep people motivated, inspired, because they see that the product is not selling, right? So they're trying to come up with new strategies. That takes away their focus from other things that they need to do. And of course, the output declines.
And then often losing money on selling out overstocks at a high CAC, low gross margin, and creating more of a minus. But yeah, essentially, so you're saying overstocks equals lock or dead money that you need to reconvert into real money as soon as possible. So how would, let's say in your past experience, what for you were your best approaches to terminate overstocks without really making a big loss?
Mm-hmm. Yeah, I mean, the best way to do it is bundles, right? Bundles offers to your existing customers, to new customers. So let's say I'd rather give away 50% on dead stock, than carry it for months, right? So the best way to do it is to offer a bundle, maybe give it away for free as well, as long as that boosts your conversion rate or average order value, right? So get more of something now, even if that means sacrificing some of the dead stock, than carrying it and, carrying it to the future, incurring more costs and more stress and more decline in productivity, right? I would say get rid of it. And the best strategy, as I said, is bundles, special offers, giveaways as well, right? Why carry that product? Just give it away to your most, your top customers. Identify 20 top customers, give it away to them for free, get some more feedback from them about the product. Understand why exactly it's not selling, right? Get some feedback from them, understand, and maybe reiterate a little bit. Maybe there is just one component or messaging that doesn't resonate, and maybe it's overstock or dead stock because of some marketing issues, not because of the product issues, right? Maybe
forecasting.
Forecasting as well, right? So you got to understand the source of the problem, right? Is it a marketing problem? Is it an operations problem? Or is it just not a good product, right? So you made a mistake with your product development and you screwed up. So just swallow that loss, get rid of the product, convert it to cash as quickly as possible, because again, the underlying costs are really high.
Yeah. And I would add a couple of other points to this one. So number one thing that we figured out 5-6 years ago, so we ran into huge overstocks. We were running out of money for a while. And then we just started putting these overstocks as impulse purchase shopping cart upsells. So instead of our regular retail price, which is roughly 14 to 19 euros per product, we would start selling these at roughly $6 to $7 euros, still at a very decent COGS. So we were making a very nice gross margin on that. And we just started selling it out like crazy. And that actually brought us to the idea of now creating special products just for impulse purchases in the shopping cart, where you can show a really nice discount. It needs to be a product that has a really nice impulse purchase potential. So it's something that everyone needs, and we're going to have a super low COGS. And that's really great for boosting your profitability. Now, another two things that we did a few times is just selling it out to other retailers, even at cost, just to get some money in. And in two cases, we were actually sold it at a loss because we needed cash flow. And of course, we were producing our own product, so that was relatively easy. We needed cash, so essentially we just terminated overstocks at a loss. It made a bit of a painful P&L, but on the cash flow side, it was actually almost pure profit because we had produced this stock like 8, 9, 10 months ago. So it actually saved our cash flow position at the time. Okay. So one of the things that you're often saying is that online retailers simply have too big product portfolios, and instead of continuously thinking just how to make more, add more product, that often when you're doing your analysis, you see that actually they need less inventory, less products, less SKUs. What's your reasoning for this, and what's your approach?
Yeah, listen, I'm not against more products, right? But I think it has to be strategic and backed up by data, right? You can't just launch a bunch of new products without firstly coordinating your marketing campaigns, right? Because and I've had these experiences when you would launch 10 new products without real marketing push, right? And your customers will not know about this, right? And if you introduce 10 new products at the same time, that's just decision fatigue, right? Customers will not know, okay, which one should I try? Like, should I try this one, that one? So it's very complicating, right? I would say, if you do launch new products, make it strategic, make it regular, right? So that people can anticipate. And I mean, the fashion and apparel industry is the best example, right? There's seasonal drops every 3 months, right? Look at Louis Vuitton, look at Gucci, right? The work they do, the amount of confidence.
The daily drops.
The daily drops. Yeah, exactly. Yeah, so if you analyze some of the top fashion brands, right? They have very strategic way of launching new products, and it always pays off, right? Because their customers know exactly when to anticipate new product releases. They know that they can expect the best quality because they don't do it as often. They do it regularly, seasonally, right? 4 times a year, let's say. But they know that this is going to be some of the top products, right? And it should be the same in any industry, right? You don't want to overwhelm your consumer with a lot of different options at the same time. So, taking a step back, understanding why we're launching new products, how we're launching new products, when we're launching new products. All these questions must be answered before you consider adding new products to the catalog. Can we afford to launch new products? That's the most important question, right? Because you have to understand the cash flow implications, the profitability implications. Consider the sales cannibalization as well, because if you launch a new product, chances are it will take away some of the sales and revenue from your top sellers, right? Because that's how it goes. You add a new product, people focus on that new product, you lose value there. Can you swallow that? Did you overstock on the top seller as well? Did you consider the implications of launching new products? So all these things, right? Now, the reason why most of the brands need to cut products is because they've launched too many, right? And that's why I'm such a strong proponent of cutting products. They've launched too many. Now they're struggling, and the acquisition costs have gone up, right? It's more expensive to acquire new customers. The cost of capital has gone up, right? It's no longer 0% interest on debt. Yep. So you cannot finance that inventory for a long time. So if you make a mistake with launching new products, that's going to be costly, and you want to cut down the number of products that you carry because you want to be intentional. You want to have focus in your marketing strategy in how people and your consumers perceive your brand, right? Not just being a go-to marketplace for any product that I want. Be intentional, build a product, build a brand around a certain number of products, let's say 2 or 3 products, and then add in some of the additional drops that, special releases, maybe just seasonal drops, right? Don't go too crazy. Just try them out. See if they fit in larger picture before you add them to the product catalog. Just order an MOQ order from your supplier, right? Don't make as much profit, but try it out first before you commit to another product in your product catalog.
But how do you cut? So let's say that your analysis shows that one of your clients has like a portfolio of 100K products, and you see that it's just too much. A lot of it is not moving. How would you advise them to start cutting it step by step? What will your process be?
Well, there's a cool analysis, and there's different approaches to this, right? But I like the ABC analysis, right? It's ranking your products in terms of sales, in terms of profitability, in terms of returns, right? Maybe there is a product that sells a lot, but 25% of it is returned, right? For some reason. Rank the products, give them a certain score, right? I would say a combination of both profitability and sales, right? Because you want volume, but you also want profitability. And sometimes you might sell a product that only has 20% gross profit margin, but it sells a ton. And the second product sells, less, but it's much more profitable. So of course, the second product would be more valuable in terms of that score, right? So identify these products, understand, and give them a score or give them a rating of A, B, or C, right? If the sell-through rate is low, let's say it sells through within 365 days, that's a C product. If the sales volume is low, it's a C product, right? If it's only like 0.5% in terms of profitability, that's a C product, right? The C products are the ones that you should get rid of right away. Don't hold on to them. If there's a lot of stock for those C products, get rid of it, convert it to cash, and keep going, right? The A sellers are the ones you want to focus on, right? These are core to your brand identity. And the B products, you got to monitor them, test them and monitor, right? If they're closer to A's, of course, try to, make a strategic change. Perhaps the reason why they're B is because you're not putting any focus on them, but they have a lot of potential to become an A, right? Try that. Maybe for 3 months, test this product specifically, change your creatives, change your focus a little bit and see if that takes you anywhere, right? If it doesn't, then keep it in B. And then any product closer to C category, I would say, try to renegotiate terms with suppliers. If it doesn't help, reducing the number of products that you need to buy from them. If the lead times are not improved, if you have to make payments up front, right, for deposit or whatever it is before shipping, and it takes a long time to convert that product into cash, then maybe it's a good idea to let that product go as well.
So this very nicely brings us to the growth versus efficiency debate. Now, personally, I admit in my past, I often scaled too fast, and that was before getting the fundamentals in place. So I've been in this business a long time. I learned everything. I learned every little thing every year and then try to improve. But how would you steer for growth while then still keeping efficiency in mind?
Well, there's a couple of components, right, to it. I would say you've got your, if you look at the P&L and you say, okay, so every dollar we earn, we got to understand where that dollar goes, right? So most of the time, anywhere from 20 to 40% of your dollar earned goes towards your supply chain, right? So it's the product itself, the landed cost of that product, the last mile delivery, 3PL costs if you're shipping with a partner, 3PL partner, and internal fulfillment costs if you're shipping on your own terms, right? So that's anywhere from 20 to 40%. Of course, in some industries it can go even above that. Let's say CPG, it can be more than that, it can be 60%, right? But that's a good range, right? Then marketing. Marketing is another component. A good chunk of your money goes towards marketing, right? And again, there's a lot of different optimizations within marketing that you can make because the customer journey is so expansive, right? There are so many components, so many factors that you have to keep track of. But marketing is another piece that usually, anywhere from 15 to 35% will go towards marketing, right? And then the rest is your OPEX, operating expenses, right? So it's your personnel, it's your cloud tools, software, whatever it is, right? So when it comes to supply chain, there's so much you can do with supply chain at early stages when you grow, right? Because you don't have leverage, you don't have negotiating power, you don't have volume, right? So there's so much optimization you can do. And I would say if you're growing at the beginning, you don't have a chance to cut it significantly, right? So don't focus too much there. Now, marketing is a really tough one because it requires an upfront investment. If you work with a growth partner, right, they will usually ask for a huge fee every month, right? So it's a commitment that you're making. And I would say it can be a hit or miss, right? You can either really grow efficiently, right? Build out collaborations, build out partnerships, maybe use YouTube instead of Facebook and Instagram, like some of the biggest players in the space do successfully. So, you can find ways to optimize marketing, but again, it can be a hit or miss. The biggest thing that you have control over when you grow is your OPEX, operating expenses. Trying to grow as efficiently as possible pretty much stems from operating expenses. If you overhire too many people, if you get on board more people than you need, right, than your business needs at this stage, you're wasting money that you could have invested in more marketing to grow further, right? Because supply chain is profitability, marketing is growth, and OPEX is kind of a combination of two, right? So operating expenses are the biggest lever that businesses have at early stages as they try to grow. I would say find top talent, pay them more. Perhaps they're going to be generalists, right? And I made a post recently about 5 critical roles on a new or growing team. I would say the core ones are the founder himself, and usually founders should be focused on product development, understanding the bigger picture, right? Driving and motivating the team. The second one would be a growth marketer, either fractional, growth marketing agency or a full-time growth marketer who knows their shit, right? It can't be someone who doesn't have experience with anything, right? If they're clueless about performance marketing, they're clueless about creative copy, like it's not the right growth marketer for you, right? Better find someone who's more expensive, right? But get someone who understands that. It doesn't have to be perfect, right? But they have to understand all these things. Otherwise, they're not a growth marketer, right? The third person is operational finance person, right? And it's someone who has experience with operations and finance because you can't afford to get both. These are very expensive, right? You can't get a CFO, you can't get a CEO at the same time. And you want someone who understands the dynamic, right, across the back-end processes. The fourth person is the customer service person, right? Because as you grow, you're going to get a lot of inquiries, a lot of requests. You want someone who comes in and maintains your brand presence, who is the voice of your company, who is the bridge between the customer and the brand, right? That person is very critical and can be a VA or a full-time person or a part-time person, depending on your finances. And the last person is a bookkeeper, right? Someone who helps the operational finance person, unless the operational finance person can do it all. I would get a cheap bookkeeping firm that can do that. And if you have more finances left over, I would say get a performance marketer on your team, someone who is very analytical, in terms of marketing, and let the growth marketer focus on the creative side, on the copy side, on building out the voice and the brand. And then the seventh person I would say would be a creative person, right? Someone who can come up, killer content, killer photography, killer videography, really build out your brand visually across different channels. Of course, that depends on what kind of brand you're building, but I would say this is 5 to 7 roles that you need. If you hire anyone beyond that, you're probably wasting money because you could have instead hired someone on a project basis, right? So hire a web developer in sprints rather than full-time basis to make improvements to your website because otherwise you're wasting money, right? Make it as intentional as possible. You want to change your website, don't change it on the go every day. Make intentional changes every 3 months, every quarter, and hire that person on a project basis. And the same goes for any aspect of the business that, let's say, growth marketer doesn't understand. If they're not good at copy, get a copywriter on a project basis, right? On an hourly basis. Whenever you need, pull the trigger, get them to write content, and that's it.
Then when scaling the business, let's say that you're adding a bit of complexity, maybe you're adding brands, maybe you're adding new geographical markets. Like, for example, I know we went from a couple of markets to 18, scaled the organization from a couple of dozen people to in the end, more than 300. So at what point would you then actually start adding more employees? What financial KPIs would you be looking at to sort of give you the message, yes, now is the time to add more people. Now you can do it. Now you're secure enough to do it.
Well, the question is, why would you, right? If everything is working and you're growing and you're being profitable, why do you need more people? Unless you have to get more people.
You want more growth, man. You want to go from 10 million to 20 to 30 to 40 to 50.
Sure. Yeah. I mean, beyond 10 million, you probably need more people, right? I would say try to keep your annual payroll under 15%, right? 15 or less. Because if anything beyond that is probably killing your profitability substantially, right? So let's say if you're 10 million, $1,500,000 is the top amount of money that you're going to spend on people, right?
No, that's already quite a lot of people, right? I mean, okay, maybe not a lot of developers, but it's still quite a lot of people to do the work.
For sure, yeah, that's a huge headcount, and I think as you grow to 20 million, 10 to 15% of your revenue should be in payroll, no more than that.
Okay, let's switch gears. So we know that omnichannel is really becoming more and more a go-to for direct consumer brands because we're all seeing profitability erode a bit. We're seeing customer acquisition costs go up. And omnichannel is really a super nice way to leverage all of your marketing investments across multiple sales locations, really take advantage of the brand power you've built, with the demand you build, increase product availability, mental availability, and essentially sell more. What's your take on measuring channel profitability in an omnichannel world?
Yeah, this is an ongoing challenge, right? How do you attribute cost properly? And there's no one clear way of doing it. And sometimes that requires intuition, right? Your understanding of how everything functions. And again, the goal is not to blame one department or one channel for the downfall of profitability at the corporate level, right? The idea is to understand, are we being efficient? And perhaps there's, give it a bit of safety margin and say, okay, maybe we're wrong by 5 to 10%, right? But again, the idea is to understand where we should be investing money. Because if there is a stark difference in channels, perhaps, you should focus on the one that drives the most value, right? I would say, the first step is to, the variable costs are easy to attribute, right? Because they're attached to the product that is sold, right? So it's much easier to understand if we sell it through this channel, so it's attributed to that, right? Marketing costs are very tough, right? Because again, since iOS 14 update, it's nearly impossible to attribute marketing properly. What we could do is to use post-purchase surveys, right? To understand what was the last touch point, for instance, or what kind of, maybe you don't need to know the last touch point, but maybe what was the most influential one of them, right? Maybe there is a Facebook ad that they saw and they were like, yeah, I remember that brand, right? And that was the last bit that got them to buy a product, right? So something that is the most impactful, because what you want to find is the most impactful channels, right? Not the last touch point or not the last. And people will remember the most impactful channel because that sits in there at the top of their mind. So purchase surveys are a very powerful way to try and attribute your marketing spend. In terms of overhead and operating expenses, that's much tougher, right? Unless you have fixed costs that are allocated to a specific, channel. But I would say, if you have a headcount and everyone works on all channels, wholesale, retail, the best way you can do is to maybe run a test for 1 month. Ask people to track their time in a tool so that they can allocate, okay, I worked 4 hours this week on this project, right? I worked 4 hours on this project, and that's attached to Amazon channel. This project is attached to Shopify. And then at the end of the month, as a test period, you can, calculate the time allocation of all your employees and, get a guesstimate of what their time commitment looks like for each channel. And that's the best way you can do it, right? And again, it's not going to be a foolproof approach, right? Of course, there's going to be a hit or a miss, but you got to try to capture productivity and commitment from your people.
So what we often saw in our businesses is then when we start adding omnichannel to the mix, so mainly Amazon and other distribution players like online retailers, other marketplaces, essentially weren't spending a lot of marketing money there, but of course they started picking up on sales because of all the demand we generated through other channels, mainly Facebook, influencers, so mainly push channels. But then of course direct consumer sales dropped, omni-channel sales increased, and total profits in the end increased because most of these channels were still relatively cheap. But we still had to manage our ad spend mainly on the direct consumer side, and it meant that our direct consumer profitability slowly started eroding, but omni-channel was sort of making up for that. So I think it is important that when people start doing omni-channel attribution, start attributing costs, they don't just look at it like, like a horse, super straight road. They always need to take into consideration what is driving what in the whole big picture. Is that they otherwise just run the risk of essentially killing their demand generators, which will consequently make their pull channels or their pickup channels like Amazon gradually start leveling off. I think that is the real danger.
Yeah, and also part of that is scalability, right? Potentially one of the channels is not delivering more to you, but is it scalable, right? Because right now it's not as profitable, it's not as cash flow positive, but potentially it's very scalable. And once you get to the volume needed, you're going to collect that cash easily, right? And you got to evaluate every aspect of each channel and understand, okay, are we playing the long-term game, a short-term game? What are we trying to fix by adding more channels?
Okay, so now to change gears just a little bit to one of my favorite questions. I really like that your input on this one. So one of my friends, he's running a business that's doing roughly 100 million per year, purely direct consumer, driven only by Facebook, super low retention, super low anything else. Again, mainly Facebook. His current profit margin is about 5%, and he knows that he can improve it by about 50% if he decreases his acquisition spend and growth. But he's also a bit reluctant to really do it because at this high volume of sales, it also means that his purchasing power with his suppliers is super big. He can essentially outbuy everyone else on the market. He can really, when a hero product starts selling, he can always get enough stock on time to keep pushing it. And he rather prefers higher revenues at a lower profit margin because, again, he still makes a bit more money in total. But he knows that otherwise he would just have to decrease acquisition costs, which would increase his net profit margin, but would also worsen his cost of sales. So what would you advise him?
Well, first of all, it sounds like a drop shipping business in a Walmart setup. Very powerful, but very tight margins. No, that's an interesting question. I mean, to be honest, it depends on how low can he go with suppliers, right? Because let's say for him to keep this unit price as is, right, he can go down another, let's say another 5,000 units per order, and I'm not sure, what his average ticket is, right?
Probably, yeah.
Yeah. So why not do that, right? If you can still maintain the same terms with your suppliers, that's not affecting your margin, right? You're not sacrificing any of your gross margin, but you could have a chance of lowering your CAC. So you're finding that optimal point, right, of total output, because again, the total output depends on your let's say your conversion rate, which affects your customer acquisition costs, right? And it depends on your gross margin, right? So if you can find that optimal point of optimizing your gross margin while maximizing your conversion rate and lowering your customer acquisition cost, then work towards that. And I would say, because especially on $100 million, 1% improvement, that's $1 million, right?
Okay, so essentially still go into optimization, but do it super small without worsening your purchasing terms, and maybe try to not go for a 50% decrease in sales or acquisition costs, but maybe 5, 6, 7 percentage points just to get a couple of percentage points better on the net profit. Hey, that's actually nice. I will ask him to look at this video. Okay, I think we're slowly running out of time. So now just one last final question. So as an e-commerce CFO, what are really the top e-commerce KPIs you believe that e-commerce businesses should track daily, monthly, on a consistent basis?
Well, okay, I'll share one that I think is very interesting, and not a lot of people talk about this, and I will credit John Ivanko. He is huge in the e-commerce space, and he's shared this, a tremendous number of times with me. But it's a subscriber to conversion rate. So essentially, let's say you spend $10,000 every month to acquire customers. And what we usually do is we say we spent $10,000, we acquired 100 new customers. That means our customer acquisition cost is $100. But that's not really the case. What you have is waste in your new customers because you actually acquired more than that $100, but some of them have stayed as subscribers and haven't bought yet, right? So what you're not doing is you're not optimizing your customer acquisition cost by engaging the subscribers in your list, right? So are you tracking your subscriber to conversion rate? And I think this is something very new that not a lot of people are talking about because zero-party data is something new, especially in Europe. The US is kind of one step ahead there, but zero-party data is very critical. And anyone who wants to get, more insight about this, please speak to John Ivanko. He's huge on LinkedIn, very great person. And I think he's going to open up your eyes on some of the KPIs that you're tracking for no reason. So I would say number one with potential value add is subscriber to conversion. Of course, the basic ones, I would say the top three would be tracking the dynamic of your customer acquisition cost, LTV value by cohort, right? Understanding where we're moving and what direction are we moving. These are very critical, right? Because if you're not making money on the first purchase from new customers, you have to recoup that investment at some point in the future, right? And you also want to get as close as possible to profitability, right? But unless, of course, you're being strategic, you're giving away discounts because you know that they're going to stick for a long time and bring more value in. Sure. So track these metrics. CAC to LTV ratio is absolutely critical. I would say another two that I look at would be sell-through rate for inventory. Absolutely critical, right? How long does it take for you to turn inventory? Are you, is it 30 days? Is it 60 days, 90 days? The sort of the inverse of that sell-through rate is turnover, right? So look at turnover. How often do you flip your inventory a year, right? And then dissect each product category, each product within the category to see which ones are turning faster because that's your cash flow right there. And the third important metric I would say would be, let me think, because I'm trying to pick the most critical ones that actually add value.
Act a lot of them, so we're fine. We're fine.
Okay, let's keep these three then.
Yeah. So Val, thank you very much. This was great. Now, before we zone out, where can people find out more about you? How you can help them? How can they work with you?
Yeah, I'm very active on LinkedIn. So if you guys want to find me on LinkedIn, I'll give Rok my @ on LinkedIn, and we can chat there. You can always DM me, see some of my content I post every day. To help businesses build more profitable, more profitable businesses, to help founders build more profitable businesses. And yeah, LinkedIn would be the best source of, contact information.
Okay, perfect. Then Val, thank you very much. This was beautiful and talk to you soon.
Awesome.
Take care.
Appreciate it, Rok. Cheers, guys.
And training